Most of us follow a specific financial blueprint. Go to school, secure a reliable 40-hour-a-week job, collect a steady salary, and eventually retire. But this framework is restricted by a specific mathematical limit. In a standard 9-to-5, your growth is tied to a 1-to-1 ratio, where 1 unit of time produces 1 fixed unit of pay. This chart plots hours worked against money earned. This is linear income. Because it requires your physical presence, you are trading your time for a fixed return. When you stop working, the line hits a hard ceiling. Wealth operates on an exponential curve. It is built on assets, like equities or businesses, that grow independently of physical labor. While a standard job provides the baseline income needed for survival, its fixed structure makes it difficult for that income to scale. By definition, a salary trades the massive upside of asset growth for the perceived security of a steady check. The first barrier is the physical cap of time. There are only 24 hours in a day. If your income depends on your presence, your earning capacity is inherently finite. In many European nations, high productivity often translates into fewer hours worked. In the U.S. labor market, workers generally trade that productivity for higher wages, leading to exceptionally long work weeks. This chart shows the risk of a fixed salary. If your pay is static, every extra hour at the office reduces your effective hourly rate. Working more drives the value of your labor down, not up. As you can see by this threshold line, the legal structure reinforces this cap. Federal law allows employers to classify certain workers as exempt from overtime pay if they earn more than $684 a week. Employers can legally demand extra hours with zero increase in compensation. Even for those who secure higher wages, progressive taxation creates a second ceiling. Because high W-2 earners are taxed at higher rates, the effort required to increase your disposable income grows more difficult with every raise. Federal rules also limit your ability to shelter that income. For example, 401k contributions are capped at $24,500 annually, limiting how much you can move from a taxed salary into a growth asset. In this system, working harder leads to diminishing returns. Physical exhaustion and tax brackets neutralize your extra effort before it can accumulate into significant wealth. The final barrier is the power cap. Generating wealth requires the ability to dictate the terms of your labor, which a standard employment contract rarely allows. Polling data highlights this imbalance. 40% of American workers report having little to no leverage to negotiate their working conditions. Without leverage, the surplus value you create belongs to someone else. If your labor generates millions in profit for a company, that value flows to equity holders, while your salary remains fixed. This dynamic creates a debt overhang. When a capped salary fails to keep pace with rising costs, workers are forced to bridge the gap through borrowing. Modern employment often relies on debt, mortgages, auto loans, and credit cards, simply to maintain a standard of living that the base salary alone no longer covers. The resulting debt service payments consume your remaining disposable income. This neutralizes your ability to invest in the very assets that could offer a way out. This is the trap. Your labor builds equity for the business owner, while your debt keeps you tied to the 9-to-5 just to service the cost of your own survival. Earning potential must be decoupled from physical presence. You cannot build wealth while your income is tethered to your finite hours. This isn't just about math, it's about well-being. Research consistently shows that people who prioritize time over money report higher levels of happiness and life satisfaction. A 9-to-5 job is a tool. It is a logical way to secure your basic needs and establish a capital base. The strategy is to use that base income to acquire assets that offer leverage. This means moving capital into equities, investments, or business interests, where growth is not tied to your clock-in time. Wealth exists at the point where your assets generate enough autonomous income to purchase your time. Use daily labor as the capital required to acquire assets, which serve as the final objective. Subscribe if you want to understand how money really grows.